Welcome back. Time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Rob Tetrault. He's with Tetrault Wealth Advisory Group in Winnipeg to talk about asset allocation, and specifically, Rob, your view that ordinary retail investors need to think beyond what is a very common asset allocation in their portfolios, and that is a mix of stocks and bonds, the 60-40 portfolio perhaps, often derived from investments in mutual funds or ETFs or individual stocks and debt instruments. You think they need to think more clearly, more strongly about alternative assets. Why don't you begin explaining?
Yeah, I've seen a lot of people come to me with their portfolios from other institutions, Paul, and I've done a lot of research on this, on asset allocation, on the institutional side, on the endowment side. And, you know, the viewers that follow this trend and have seen this over years know that on a 10-year, 15-year, 20-year, 100-year number, a portfolio with a mix of alternative assets such as, you know, apartments, private real estate, infrastructure holdings, private equity holdings, you know, music royalties, farmland, storage units, that kind of stuff will outperform both on an absolute return basis and on a risk-adjusted basis. So if you just care about returns, you're going to outperform. And more importantly, like most Canadians, if you want to do it with less volatility, if you want better risk-adjusted returns, so less standard deviation, less day-to-day, week-to-week, month volatility, you're going to do it better with a portfolio that has some exposure to alternative asset allocation. The data shows that adding 10% does wonders, adding 20% also improves it, and even adding 30 all the way up to 45% exposure to alts. Now, I'm not saying every Canadian needs to have 45%. That's not what I'm saying. But I'm saying they need to start looking at this, and if they don't have this, they need to talk to their advisor about this. It's frustrating to see the same portfolios for every single Canadian. Every single time I meet someone and they come and talk to me and they show me their portfolio, they go, Rob, why am I underperforming? Why am I doing so poorly over the last 2-3 years? Well, you have 40% of your portfolio that's returned negative returns. So let's start there.
Okay, let's put up a graph that you've brought to us. It's a dot graph, and we'll bring it up now, and you can explain what this is showing. This shows the performance of alternative assets as they are owned by endowments. Now, so the white dot on the far left of the screen, it reflects that typical 60-40 equity fixed income portfolio. As we move to the right, we see a series of colored dots. The first one is the average U.S. endowment fund. It has a greater return, and you can see, I believe that fund has a 30% weighting in alternative assets. You'll correct me if I'm wrong. As we move to the right, we see larger endowment funds with greater proportions of alternative assets in their holdings. And on the vertical scale, you can see percentage returns, and those returns get higher as well. Moving to the top right of the graph, we see a red dot and a black dot. The red dot is the top 5 U.S. endowment funds. The black dot is the so-called super endowment funds. And there you see, on the horizontal scale, a heavier weighting to alternative assets and stronger returns over time. Rob?
I love this chart. It's very simple. It explains it simply that the more exposure you have to alts, the higher annualized return would be. There's another one that I really like, which is a comparison of volatility along with return and having exposure to alts. And it's a similar chart, which is the more exposure you have to alts, the less volatility you have. Isn't that the holy grail of investing, Paul? We want better returns with less volatility. Like, that's what everyone wants. So I love this. I think, you know, the U.S. endowments have been doing this for 80 years, and it's kind of been brought to the forefront in the 60s, 70s. A lot of research was done around this. I read about this and studied this during my MBA, and I think only now are we starting to see it in the retail space. And I believe, let's go. Enough's enough. Let's start doing this for clients.
Okay, give me a very quick answer here, because we have another topic we want to get to. But how do retail investors get exposure to things like music royalties, for instance, or private infrastructure? What type of instruments are available?
Well, I know at our shop, I know we do it through either LPs or through actual funds or through private pools, stuff like that. We have exposure to pension style managers, whether it's, you know, ICM, they do music royalties. There's a whole bunch of private real estate offerings. You know, Farmland Avenue Living does a farmland offering. Veripath does a farmland offering. These things exist right now, and they're on the shelf at most of the progressive independent firms like ours anyways. And I know that I can access that for my clients. So